Hello again, this is Dr. Lindsay. And in this video, I want to go over the answers to the practice handout on the yield curve business cycles. So the first question is, what would happen to the yield of the 5-year note if the price of the 10-year T-note fell? So remember that bonds are substitutes for each other, just like blue pins and black pins. They're substitutes. The price of the black pins goes up. People buy less of them. Law of demand, price goes up, they buy less. And what do? They substitute over to buy the blue pins because they're now relatively cheaper. And the demand increases for the blue pins, making the blue pins price go up because they're substitutes. So if the blue pin prices fell, the black pin prices are going to fall. Blue prices go up, black ones go up too. So same thing with bonds. So the price of the 10-year notes fall. Okay, so we have this equilibrium here on the 10-year note right here. This is the price. What would make the price of the 10 years fall? Well, either supply would have to increase or demand would have to decrease. Either one of those would make the price fall. So let's say the supply increased for these 10-year notes. Maybe the US Treasury decides to sell more of these 10-year notes because they need to finance some sort of deficit or some government spending. Now, as usual, I draw these as a vertical line, meaning that there's a fixed quantity of bonds at any particular time. And I don't think that the supply curve is upward sloping because I don't think the Treasury starts issuing more of them as the interest rates go up. They have their own reasons for issuing more bonds, and it has to do with how much they're collecting in taxes and spending. So let's say the supply increased and the price fell. So the price would fall. And what would happen to the yield if the price fell? The yield does the opposite. It goes up. So the yield, the annualized yield, how much interest is going to be paid in 1 year on these 10-year bonds goes up. The 5-year is a substitute for the 10 years. So price on the 10 years go down, the yields go up. That makes the 10 years more attractive. They're paying a higher interest rate, higher yield on them. Makes them more attractive than the 5-year. So the demand falls on the 5 years and the price falls. So the price falls on the 5-year. And what happens on the yield on the 5-year? It does the opposite, so the yield increases. So price falls on the 10-year, makes the price fall on the 5-year. And yields do the opposite. So the yield on the 5-year, the answer to the question, yield on the 5-year T-note increases. Now, next question, how would this change the yield curve? Well, say our yield curve looks something like this, a normal shape of a yield curve. And this will be the yield on the 10-year. Here's the yield on the 5-year. Well, if the yield on the 10-year goes up a little bit, one thing we don't see is the yield curve suddenly going up like this and coming back down. That doesn't happen. So because the 5-year is a substitute, we'll see the 5-year yield go up too. We might see the 30-year go up too. Essentially, the entire yield curve moves up. It may change its shape a little bit. It may not be as positive as it was before. It may flatten out a little, who knows? But essentially, the whole thing moves up together or moves down together because these bonds are close substitutes for each other. Now, what about the next question? It said, what would happen to the yield curve on corporate bonds? Draw the changes below. Well, remember, corporate bonds, they pay a little higher interest, a little higher yield, because there's more risk to holding the corporate bonds because they could default. Remember, there's a risk premium, which is a higher yield on them because of the higher risk. So let's say here, this normal shaped yield curve, this is the yield curve for government bonds. And we've seen that this is going to shift up together. And what about the corporate bonds? Well, let's say that this had been the yield curve for corporate bonds that all have the same rating. Maybe they're AAA corporate bonds, but corporate bonds, because they also have this positively sloped yield curve. The longer term corporate bonds are going to pay more than the short term corporate bonds. So they generally have this positive slope. And the corporate bonds are substitutes for government bonds. If you're thinking about buying bonds, what you buy, well, you can buy the government bonds, you can buy GM bonds, you can buy Apple bonds if they make bonds, and Microsoft. They pay a little higher interest rate, why not? But then there's a little more of a risk to a default. What'll happen is corporate bonds yields will go up too. And the 5 years are substitute for the 10 and so forth. So we'll see this entire yield curve for corporate bonds also shift up. So when interest rates start going up, all interest rates start going up. It's not just a few. You can't say, oh, just the 10-year yields start going up. No, all the government bonds go up. All the corporate bonds start going up. It's like there's a million different interest rates in our society, but in general, they're all kind of going up together, or they're all kind of falling together. Why? They're all substitutes for each other. Why do interest rates tend to rise all around the world at the same time or come down around the world at the same time? Because there's a substitutability between them. The substitutes is very important in macroeconomics. So think about this. You have a lot of money and you want to hold it somewhere in the portfolio. Where do you put it? Well, there's lots of things you can do with it. You can hold some gold with it. You can put it in some stocks. You can put it in some bonds. You can put it in some real estate. Lots of different things. But to some degree, they're all kind of substitutes. Different places you can put your money. So when interest rates fall on these government bonds, the price of the bonds go up. The corporate bond prices are going up because they're close substitutes. And these other things where you can put your wealth start going up too. So interest rates are coming down, the stock market goes up. It's not really too surprising to see the stock market at all-time highs when interest rates are falling so much. And of course, real estate is also going up too. All these kind of assets where you can put your money into will tend to start going up when the interest rates fall.